So welcome to the show. We're going to go pretty fast here because by my calculations, I figure I only have about 10 minutes to capture your attention when talking about anything with the word ethics in it. Here's a summary disclosure, super important, so be sure to come back to it. Here's a quick slide on this end. As Brendan mentioned, we're data-centric tech investors, which means we invest in the data economy. We see industries being transformed by the widespread expectation that all decisions should be made based on data. And we back early stage companies that are set to power the data-centric future state of those industries. And how's it going so far? Well, it's been a bit of a wild summer in the markets. The talk at the beginning of the summer was all about inflation, and then it was about no inflation, and then transitory inflation. Then it was catastrophic inflation, and then back to normal, healthy inflation all over again. And over the same time period, for retail figures, it was all about no COVID, and then COVID all over again, sadly. Bafflingly, this sent the demand for shipping containers and hospital beds soaring at the very same time. And all the while, the US market has been almost invariably up, now up more than 6% for just the summer, which is crazy because it seems like the S&P got vaccinated against uncertainty. What I'd like to highlight today that's a symptom of recent market behavior is the social contract, and sadly, how it's failing in a quiet corner of the capital markets. And what I mean by the social contract is, after we transact with one another, that I won't then kill the transacting partner and take their stuff. And what I mean by a quiet corner of the capital markets is venture capital. As if you weren't already aware, venture capital is experiencing a banner year, capping off a decade of growth at a CAGR of 25.9%. Just think about that. The market doubled every 3 years for more than a decade. The space is continually setting and exceeding records. Assets under management surpassed 1.2 trillion in 2020, which was up 11.6% year on year, and is set to exceed that in just the third quarter this year. The average venture capital fund size surpassed 157 million, which was up 26% year on year, and it already exceeded that in the second quarter of this year. It's a great time to be investing in new ventures, with allocations increasing from family offices, corporate investors, foundations, endowments, even hedge funds, and the rowdy ones too. Yeah, you can ask me all about that later. I've got some things to say. And because of this booming period, where social contract markets are supposed to be self-policing, where aberrant behavior is rooted out by people who realize it's not worth it to transact with an unreliable partner, things are different in the venture capital world. Venture capital has an ethics problem. Think about how much you rely on the social contract in your day-to-day. When you invest in a stock, you assume the company and or subsequent investors won't devalue your stake materially. And when you invest in a manager with a unique focus, you expect that you won't end up holding the very same assets as everyone else. And when you evaluate a transaction, you expect the transacting partner to conduct themselves professionally and not degrade you in meetings or vanish altogether. And I know what you're saying to yourself now because it's what my wife tells me all the time. Stop being such a crybaby. But if you know what, we've all studied the same materials and passed the same tests. We all know what the standards of professional conduct mean and how important they are. Standards like independence and objectivity, which assures everyone that our work and our opinions aren't afflicted with circumstance or bias. Well, here's the thing. This isn't a thing in venture capital. I'll give you an example. Startups with female leaders have been found to perform 63% better than others in both returns and time to exit. Everyone knows this in venture capital. It's widespread knowledge. Given that fact pattern, what percentage would you expect the funding level for female founders to be in comparison to the overall venture capital market? Would you place it at 60%, 40%? Would you guess 50-50? Well, it's 13. 13% of companies with venture capital funding have a female leader, despite proof of better returns borne out from the data. And the situation is the very same for diverse founders also. Now, how's it possible that so few dollars make it to these promising companies? The answer is demographics. And if that doesn't highlight widespread bias in venture capital, then I don't know what to tell you. Here's another example, misrepresentation. In venture capital, we have a problem that's known as fund creep. And I'm not even scratching the surface of the Elizabeth Holmes and Theranos level yet. That type of creep comes next. The type of creep I'm talking about is scope creep. How later stage funds consistently pluck companies from earlier and earlier stages for their portfolios. This is why what used to constitute a Series A deal in 2005 looks very different from a Series A deal today in 2021. And here's an illustration. Stick with me here. Median angel and seed valuations, the very earliest stages of funding, are around $5 to $7 million right now, all the way to the right of this chart. Now you move one stage later to the Series A stage, we see that a $7 million round used to be the median early stage valuation for Series A in 2011, 10 years ago, which is all the way to the left of this chart. So what used to constitute a Series A deal 10 years ago is now an angel deal. Now check out the early stage valuations today to the right of this graph at a median of 42 million, which is in light blue. Compare that to the median late stage valuations 10 years ago in 2011. This chart shows late stage valuations. Those early stage deals used to ring the same register all the way to the left of this chart. So what this means is what used to constitute a Series C deal is now a Series A deal. Now I ask you, when you invest in a late stage manager with a 10-year horizon, which is standard, do you expect you'll end up holding early stage companies in the Series A range? No way, that would be crazy. But it happens mostly because it's been a buyer's market for so long. In those very situations, scope creep is a common problem. My final example is misconduct. And setting aside the malignant behavior that passes for professionality in venture capital, VC is one of the only capital markets in which early investors are segregated from later investors by preferred share classes. The delineation of classes is by stage, and it opens the doors to integrity-eroding behavior. For example, retail investors who are typically involved at the angel stage are segregated from professional investors who typically negotiate later stage preferred share classes. This means that they can set the deal terms, and because their check sizes are orders of magnitude bigger than retail investors, professional investors also hold way more voting rights. One of the ways that this plays out is the elimination of pro rata rights. So if an investor purchases 10% of a company's stock in an angel round, then they may have the right to maintain that 10% ownership stake in later stages to prevent dilution. And late stage investors hate this because they want to maximize their ownership as a company is de-risked on a company's path to global domination. So what they do is they vote to strike the pro rata rights of early stage investors and dilute them as they please. They squeeze out the smaller, earlier investors. Now, does that sound like the behavior of a grown-up capital market that's going to thrive in the long term? By engaging in behavior like this, what they're doing is eroding the integrity of the venture capital market, which is underpinned by the ability for early stage companies to raise capital in the first place. If companies can't raise money in earlier stages because angel investors have been burned too many times, they simply can't reach later stages, and there won't be anything for later stage managers to invest in at all. Moreover, late stage managers often rely on the diligence of early stage managers, which is how we ended up with the Theranos debacle in the first place. And if you want an entertaining moment, look up Elizabeth Holmes' TED Talk and think to yourself how it would factor into your diligence process. So in summary, venture capital has some growing up to do before it acts like a mature venture capital market. And you know what? Grown-up behavior outperforms. For Ascend, just by treating founders as professionals, maintaining a standard of care for other investors and practitioners, and by doing what we say we're going to do, we've built ironclad relationships with our founders, earning our way onto the cap table of winning companies and giving us and our partners access to rarefied air and 33% returns since 2015. Taking a stand to conduct ourselves professionally actually helps us outperform, and we're still ascending. So, venture capital's at a crossroads. On one path, we do nothing and we risk social backlash, dislocating fundamentals from market value, and destabilizing the foundation of venture capital market integrity. On the other hand, we do something. We can choose to act like professionals. And here's some of the ways that we can do that. If you're on a team that invests in venture capital fund managers, you can do a number of things. You can hold them accountable. You can hold me accountable, like having CFAs review the funds in diligence. You can also select venture capital managers who employ CFAs and who encourage their investment teams to pursue the CFA charter. Having passed the tests, we CFAs know what constitutes an ethical standard for professional conduct, and we should be applying the standard to hold venture capitalists accountable. For insiders, here's what I'm working to promote in the industry: a voluntary commitment to professionality and ethicality. Such a code would provide a framework for what constitutes ethical investing, all while promoting professional behavior throughout the industry. These are the key tenets I'm proposing, which you can also find on the Ascend website. If you're an adjacent practitioner, you're not off the hook. Here's what you can do. You can promote the practice of ethical venture capital by following Ascend Venture Capital on LinkedIn. You can learn more on my website, ascendstl.com/ethics, or by Googling ethical venture capital. You can find more about us there. Or you can find a time to talk shop and hold me personally accountable over coffee. Let's just make it a strong coffee though. So in conclusion, the venture capital market has an ethics problem. And the key thing to remember here is we can fix it simply by choosing to act like professionals. And you know what? It outperforms. Thank you so much for your time. I'm happy to answer any questions at this point.
Thank you, Ben. Appreciate the wonderful session. And as Dan mentioned, so we're moving to the Q&A session now. So if you have any questions, feel free to type your question in the chat message box or just unmute yourself directly. But actually, Dan, I received a question privately already.
Oh, okay.
Start on that one. I know this session is about ethical investing in VC, but I think someone is curious that since you are the owner of the Ascend Venture Capital, and that person is curious how did you get started to start on VC?
Yeah, so in a previous life, I was an engineer. I was an offshore performance engineer, mostly internationally. And then I came to St. Louis to do business school. And in the chrysalis of business school, I was transformed into a finance moth and ended up starting a couple of businesses on the path to starting a venture capital company of my own with limited successes, and ended up getting poached by another investor here in town. Worked with them for a little bit and then ended up leaving to join a high growth company in the logistics world that was also a startup at that point as the CFO. And then along the way had started doing some investing out of what is now Fund One. And the performance of Fund One was pretty stellar. So that propelled me to be able to raise a Fund Two in 2018 and go pro essentially. And the rest has been history. We've consistently been hitting above 30% of net IRR. Fund One is sitting at above 4x multiple on invested capital. So we're doing pretty well.
Thank you, Dan. Appreciate it. Yes, anyone has a question, feel free to unmute or send a message. I saw Jack. Do you have a question, Jack?
Sure. Maybe not completely on topic. I might have one or two more, but how did you get your cool profile in the Business Journal?
That was a really nice surprise. They just they reached out one day and said, "Do you want to do a phone call?" And we ended up having a nice chat. And then the worst part was when they sent the photographer to take my picture, which was even worse than like a middle school yearbook picture session because I felt so awkward. But ended up, among the stacks and stacks of pictures they ended up taking, they must have found one good one.
I like it. Maybe a little more seriously, you talked about early or seed stage investors getting diluted or crammed down by later ones. Any ideas or suggestions for protections there? Because I mean, you can invest with a reputable fund, but you don't always know what the follow-on investors look like. So any advice from that perspective would be appreciated.
Yeah, so we're early stage investors, so we run into this all the time. In fact, as a micro VC, we don't have many times the allocation on the capital table to earn us major investor rights, which generally includes that pro rata right. So we're actually in even more of a tenuous position than somebody who comes in and invests 10% at an early stage. And how we've been able to maintain our positions without being diluted every single time is by being able to forge a strong relationship with each and every founder on our portfolio. And we do that in some intentional ways. We keep the number of investments on our on each fund very small, so we can invest a lot of time in each and every company. I think if you called up any of our founders, they would tell you that same story. And what that means is that in approach of a Series B or even later round, which is likely to be sought after. In fact, Tiger has been sniffing around one of our portfolio companies for one of these, close and fund a deal within 48 hours timeline. That company is that sought after, and I called up the CEO because I've worked with him since his company was pre-revenue, and just asked him plainly, I'd love to be able to maintain our ownership percentage, and we just had a handshake agreement that ended up holding up. So our protection against that is our relationships with our founders, and those have ended up being more than enough protection for us.
Excellent. Thanks.
Thank you, Jack, for the question, and also a great answer from Dan. Actually, received another private message, and but still, if you want to ask directly, feel free to unmute yourself. But this one is a private message, so I'll ask Dan on this one. So, how much AUM is needed to start a VC? That's the first question, Dan. And the second follow-up one, how much of the AUM is your own capital? If you don't mind sharing. I know the second one might be a little more private, but I think the first one you can definitely answer, right?
Yeah. So Fund 1 is a 500K fund. So it doesn't have to be, a 9-figure sum to be able to start a venture capital fund. In fact, I'm the biggest proponent of that approach, starting small and building over time as you build a track record, because by the time you're able to extend the offer for outside investors to come in, all the processes of reporting, of finding quality deals, all those processes are already in place, so that you're not sitting on $100 million of capital without those processes already set up. So what I'm saying is that starting small is there's no substitute for that, in my opinion. The AUM for Ascend Fund 3, I think, is between 10 and 15 million, because we've had some massive inbound interest recently, and we're still in the process of onboarding all those folks. So when all is said and done, in this recent activity, I think we'll land between somewhere in 10 million and 15 million. The total target for Fund 3 is 25 million. And so summing those up in succession, Fund 1 was 500K, Fund 2 is 5 million, and then Fund 3 is a target of 25 million.
Thank you, Dan. I hope that answers to that audience. And if you have any follow-up, feel free to unmute or ask me again. I can relate to Dan. But actually, that looks like a Wes. Oh, Wes, long time no see.
How you doing? Hi, Dan. Thanks. Thank you for the presentation. So I'd say I have two quick questions. Could you talk maybe a little bit more just on the slide where you were talking about the difference in like the funding, so series A versus series C? Like, I guess I've been thinking, or like you mentioned, like the market has grown tremendously, and so like one of the things I was thinking about was, well, is that this like growth in funding for each level, is that because of increased competition and more people are willing to risk more money in order to to get the deal or get the ownership stake? I was curious to get your thoughts.
It's actually really interesting. The dollars themselves haven't changed that much outside of the growth of the AUM itself. So meaning that 25.9% annual growth is indicative of how this scope creep increases. So the interesting thing is that, like I was saying, in 2005, if you wanted to raise a Series A round, you really could be looking at a pre-revenue company or having just turned on the revenue spigot. There really wasn't anything earlier than a Series A at that point. You could have done maybe a seed deal, but that really looked like a rich aunt or rich uncle just cutting a check to your company. Now they've had to come up with so many new terms, and they're going to have to continue to come up with new terms to describe earlier and earlier rounds, right? So now, prior to a Series A, you could see, working backward, a late seed round, a bridge round, a pre-seed round, an angel round, or even a pre-angel round. And so it's crazy. And we're going to have to, again, be really creative about coming up with new names for these earlier and earlier rounds. The reasons for it, I think, are twofold. Number one, that you got to think that if you raise $100 million to invest in a venture capital fund, you're all of a sudden blessed with this, as I mentioned, buyer's market, in which you can set the terms for what constitutes your Series A hurdles, right? And what that means is that as you look around and see Series A deals that start to proliferate around you, you see that some people maintain a revenue hurdle of $1 million ARR. Some people maintain a revenue hurdle of 600K. And in order to be able to sift through the hundreds, even thousands of companies that you'll see that hit those stages, you start to generate an appetite for getting into quality companies earlier and earlier. So you'll start to place your money in earlier stage companies and call it a Series A. Does that make sense?
Mm-hmm. That's helpful. Thanks, Dan.
Yeah. The other reason is that the checks for those stage of company, like the company hurdles themselves, have been increasing as well. So right now, actually, we're in this very fascinating time in which the average valuation for a late stage company by the end of 2021, or certainly in 2022, will be a unicorn valuation. Think about that. So in 2011, there were only a handful of unicorn valuation companies, which is $1 billion company valuation. There were only a handful, if 4 or 5. And now there are so many proliferating in the markets that the average valuation for late stage companies could be a unicorn valuation. It's just staggering.
Maybe a follow-up question to that, I guess. What is your take on, my understanding with VC is that let's say 1 to 5% of the investments is what generates the majority of the VC's returns. How does that factor into to the ethics? Is that
it's pivotal. Yeah.
Right. That's okay.
Yeah. So think about this, right? So if you're investing on behalf of the fund, and your target number of portfolio companies is as is borne out by some of the calculations that you can find online. If your target is 30 companies, which is pretty standard, then you have to be able to field 30 different conversations at any given time at once, at the same time. And in my experience, that's, on top of everything else, including investor relations, including reaching out to new portfolio companies, and including diligence on current deals, on top of fundraising conversations. That number of portfolio companies is so unwieldy that it takes a backseat. So what ends up happening, and I can think off the top of my head of 5 different founders who have stories like this, is that as soon as when you're sitting in the office pitching an investor, they'll tell you all of the wonderful things in the personal contact that you'll have with their general partner. But as soon as the check is cut and you move forward, you start to hear radio silence, and that gets even worse when the winners in the portfolio start to emerge, right? So over time, as you mentioned, if 1 to 5% of companies start to really emerge as the winners, all the attention gets diverted to that few number of companies, and the rest get nothing. I've been on the receiving end of this on the operations teams of high growth companies. In fact, some of the behavior that I mentioned before, this malignant sub-professional behavior, is indicated in a story like this. So when I was out pitching this startup that I was working with, we set up a meeting in advance with one of the top investment companies in Silicon Valley. We set it all up on our schedules, planned all the travel, got the hotel rooms and the rental cars, traveled all the way out there, and went to this office in the Presidio that was just beautiful. I mean, staggeringly beautiful. The front door was like 3 stories high, and it looked like it weighed 10 tons, but you could open it with 1 finger. It was just astonishing. And I think that the success of venture capital companies often is measured by the appearance of the front door. But anyway, so we were sitting in the pitch meeting with this partner of this venture capital firm and the analyst, and the partner was just on his phone the entire time, just not paying attention at all. Halfway through the meeting, he just got up and left without context, without saying anything. He just got up and left. And the poor analyst was sitting there looking at us, saying to himself, like, I guess we'll call you. So that kind of behavior is driven by that very problem that you pointed to, is that as the number of portfolio companies goes up by tens and tens, the attention that you can afford to pay to every portfolio founder is lesser and lesser.
That's great. Thank you, Dan. Thanks again.
Thank you, Dan and Wes. That's why everybody who's coming today is very serious about the VC investing, especially very ethical. And actually, Dan will receive another question. This one, the audience is asking the ethical challenges you're concerned about the VCs. Are you aware of such problems with the SPACs, the special purpose acquisition companies? Do they also have maybe some ethical challenges that you heard of, maybe you have seen? Just curious your thoughts on that.
Yeah, that's a fascinating space, and I think that it is still developing. I think that there are some question marks that you could attribute to how you could acquire a company, sail in an outside CEO to partner with the team, and then achieve a magic return. So there are some minefields in how those are being set up. I haven't heard of any specific instances of how that's played out to date, but when you're looking at a time horizon of 12 months from from going public with your SPAC, you you start to see a lot of pressure to find a quality target. And honestly, with the number of SPACs that were launched in early this year, late 2020, there just are more SPACs than there are quality targets. And I mean, it was like 12 SPACs went public a day for a while there. And so now that the clock is running out on each of those pipes, we're going to start to see the emergence of some really odd behaviors. So so to summarize, I think that I haven't seen any behavior that makes me raise an eyebrow, but there is certainly a situation that's ripe for misconduct, I think.
Thank you, Dan. And actually, I just want to add a real quick comment on this topic, since this is an area I've been researching myself. And as Dan highlighted, the SPAC have like a kind of 2-year time horizon, trying to acquire the company. Otherwise, they have to return the capital to the investors, which
Right.
don't happen. But you probably saw on the Wall Street Journal, some of the big investors actually potentially returning the capital now to the investors. And also there's some lawsuits involved because for the SPACs, they could put out the projection for the financials before they even got acquired by a public company. So that's why they could say almost anything wanted at first, but are they going to able to deliver those results? The question is probably depends which company like you look at from a SPAC standpoint. So that's a lot of lawsuits are going around now because of the initial projections the company owners have published before the acquisition happens, and many times the investors think, okay, they are over kind of delivering some of the numbers before they even went public. So that's a kind of ethical kind of discussion going on at this point for the SPACs.
Right. Yeah.
I think that's probably good to wrap up today's meeting. I just want to say, anyone have any last minute questions? And if not, Dan, actually, I think I have one last question for you.
Okay.
If you don't mind, since most of people here from the St. Louis. So what's your favorite St. Louis restaurant? I know we cannot eat. Some people don't like to eat too often during the pandemic, but I'd like to hear your personal kind of restaurant here in town.
Yeah. So I grew up in South Asia, and so one of my favorite cuisines on the planet is South Indian food. True vegetarian, real spicy South Indian food. And there's a really terrific place in Chesterfield called the Curry Club. That's as authentic as can be. I mean, they play cricket on the TVs inside the restaurant. That place probably is one of the most one of the closest cuisines that harkens back to my childhood. So that's probably that would be among the top 3.
Okay, I can check it out. And there's someone to second that from the audience. And
I appreciate that.
thank you, Dan, for the wonderful session on the ethical based investing. And Dan has shared his email address in the chat room. If someone wants to follow up, feel free to connect with Dan by email, and also he's on LinkedIn. Dan is a very, very nice person. Anything you want to talk about VC or anything in town, I think he's more than happy to connect. But thanks again, Dan.
Thank you, Brendan. Thank you, everyone.